The debt clock in Times Square, and on the official pages of the U.S. Treasury, it is spinning past $35 trillion and accelerating toward $38 trillion. And while it climbs, interest compounds in real time against a currency you hold, and every percentage point now competes directly with the purchasing power of your dollars. For decades, it was dismissed as manageable, owed to ourselves, and outgrown by prosperity. But that belief required time and control. In 2024, both ran out. The math shifted when interest costs crossed a line no one had crossed before, and for the first time in history, the United States began spending more on interest payments than on national defense. More to compensate bondholders of the past than to equip the military of the present, and more than the entire Medicaid program. With the annual interest bill approaching $1 trillion, the budget stopped being a plan and started being prey. That change did not announce itself with a crash. It narrowed options quietly, because once interest becomes the largest line item, every new dollar of tax revenue is already spoken for. Before Congress debates how to spend it, the revenue is absorbed by obligations created years earlier. When interest absorbs that share of the budget, future programs cannot expand without new borrowing, which means the dilution required to sustain the system shifts forward into household balance sheets before it appears in legislation. After that crossing, the government no longer had the option to treat borrowing as a marginal choice. Because the cost of prior borrowing began dictating present policy before any new law was passed. What follows from that shift is not a metaphor, but a feedback loop. In a household drowning in debt, spending can be cut and subscriptions canceled. But the federal government carries obligations labeled Social Security and Medicare. Promises made to an aging population that cannot be politically revoked without ending political careers. Because those expenditures are mandatory, cutting them would close the door on re-election. So the government does not cut, and instead borrows, issuing new debt to pay the interest on old debt, which enlarges the principal and guarantees that next year's interest bill will be larger still. Each issuance removes the option of stabilizing the total, and the loop tightens further. Once borrowing becomes the mechanism that keeps promises intact, refusing to borrow becomes a breach of obligations. And restraint can no longer be timed without rupture. Once that threshold is crossed, postponing the next payment stops being an option. Every attempt at delay, therefore, arrives already behind the bill it was meant to avoid. By the time the spiral is visible, the conventional exits are already blocked. Historically, there are 3 ways to reduce a sovereign debt burden of this magnitude. But in the United States today, 2 of them are politically impossible. The third is already in motion. The first option is austerity. Raise taxes dramatically and slash spending brutally until the budget balances and the debt begins to shrink. Yet doubling income taxes or abolishing the military would detonate the economy. Any administration proposing to cut Social Security checks by 30% would not survive the next election. The American economy has become dependent on government spending, and pulling the plug would trigger a depression that no leader is willing to own. With that reality acknowledged, austerity is not debated further. It is removed. Once austerity is removed, the remaining path must cover not only interest, but also the political cost of touching mandatory programs, which forces every future adjustment to happen without the one tool that actually reduces the principal. Without austerity, there is no credible path to sustain surpluses large enough to reduce the debt in nominal terms. The larger the debt becomes, the narrower the interest rate window becomes, and the less capacity exists to absorb shocks without additional borrowing. Time stops being neutral and becomes an accelerant. The second option is default, the explicit refusal to pay. A government can walk to a podium and declare that it will not honor its bonds, as Argentina and Russia have done. But for the issuer of the global reserve currency, this is the nuclear option. The global banking system, pension funds, trade contracts, and collateral chains are built on the premise that U.S. Treasury bonds are risk-free. If that premise collapses, banks fail, trade halts, credit cards stop working, and the financial system seizes overnight. Because the United States anchors that system, an outright default would not isolate the damage. It would universalize it. That door is closed as well. Once explicit default is closed, the government cannot use the clean reset that smaller nations sometimes choose, which means the debt must be carried forward through the system, rather than cut away from it. That closure carries a downstream lock that changes what becomes impossible next. If the United States cannot break its promise openly, then any relief must come from a method that preserves the appearance of payment. And that binds every institution holding treasuries to remain inside the structure rather than flee it without breaking it. It also means the adjustment cannot be concentrated in a single announcement, because that announcement would look like default. The burden must be spread across time, which forces the state to rely on mechanisms that degrade purchasing power gradually and continuously. What remains is the path of least resistance, chosen not because it is noble, but because it is survivable. The soft default does not refuse payment. It pays every dollar owed, but ensures that those dollars buy less than they did when the debt was issued. The difference is printed. This is not framed as policy in speeches, yet it operates as policy in practice. A regime of financial repression designed to keep interest rates on government debt below the rate of inflation. If the government owes $30 trillion and inflation runs at 5%, then in purchasing power terms, the real burden shrinks by 5% per year. More than $1 trillion disappears without a tax hike or a program cut. Bondholders receive their money back, but that money commands fewer goods and services. And the erosion is explained away as supply chain issues or temporary inflation. The eraser works silently, and once this path is chosen, the government cannot restore the old value of the currency. Without restoring the real burden, it has been dissolving. So the policy becomes dependent on continued dilution to keep the math from snapping back. If the workable exit is negative real rates, letting inflation fall below interest becomes unaffordable. Because it stops the erosion while leaving the interest bill intact, price stability, therefore, ceases to be a neutral objective and becomes a fiscal threat. The balance of power that makes this possible has shifted. For 40 years, the Federal Reserve held primacy, raising interest rates to fight inflation, even at the cost of recession. But with debt approaching $38 trillion, that independence is constrained. If rates were lifted to 10%, as they were in the 1980s, annual interest payments would reach $3.8 trillion, exceeding total tax revenue and pushing the government toward collapse. Because that outcome is unacceptable, the Fed cannot raise rates high enough to extinguish inflation without bankrupting the Treasury. So it tolerates higher inflation and maintains rates lower than they would otherwise be. Fiscal dominance replaces monetary independence, and the central bank becomes an enabler of government borrowing rather than its counterweight. Once that role is accepted, it is not easily reversed. After that acceptance, the Fed's remaining room is not a choice between good outcomes, but a choice between which constraint to violate first. Because tightening hard enough to defend the currency now means accelerating the government's insolvency, and easing enough to protect solvency means tolerating further erosion. Either path weakens the credibility that once anchored both. Once the central bank is fused to solvency, any attempt to prioritize the currency over the budget becomes a direct threat to the government's ability to pay interest, and that threat makes the attempt politically and financially non-viable. The independence that once allowed painful tightening becomes conditional. Tightening hard enough to restore discipline would now force interest costs above what the Treasury can sustain. The adjustment is not dramatic. It is gradual. The debt number will continue rising, 40 trillion and then 50 trillion, while the purchasing power of the dollar trends downward. Policymakers attempt to thread a narrow path, inflating just fast enough to erode the debt, but not so fast as to trigger panic. If inflation runs at 4 or 5% for a decade, the compounding effect cuts the value of savings in half in roughly 14 years, shrinking both the real burden of the national debt and the real wealth held in bank accounts. That is the wager. Inflate away half the debt and half your savings by the mid-2030s, and hope markets accept the pace. Once the wager is placed, the system cannot pause without halting the only available erosion mechanism. Halting it would instantly expose the full nominal burden that has been deferred. Every year of continuation, therefore, increases the cost of reversal. The mechanisms that enable this process are not new. After World War II, U.S. debt to GDP reached 119%, and the government liquidated it through negative real interest rates. The Federal Reserve capped interest rates around 2.5%, while inflation averaged above 6%, transferring purchasing power from bondholders to the state year after year. Today, the strategy returns, updated with modern tools designed to ensure that the transfer proceeds with minimal resistance. Once precedent becomes template, the modern system stops improvising and starts standardizing. Standardized tools are harder to unwind because institutions are rebuilt around them. One of those tools is the captive buyer. In an unmanipulated market, a government with $38 trillion in debt would be forced to pay a higher interest rate to attract lenders. But the United States cannot afford that rate. Through regulations such as Basel III and Dodd-Frank, U.S. Treasuries are designated high-quality liquid assets. Banks, insurance companies, and pension funds are required to hold them to satisfy liquidity coverage ratios. Regardless of yield or real loss, these institutions must buy and hold government debt to remain compliant. Artificial demand replaces voluntary demand, and the market signal that would normally raise borrowing costs is muted. Once buyers are made captive, the government no longer needs persuasion to fund itself at suppressed rates. But it also loses the ability to discover true market pricing without risking destabilization. The second tool is the broken compass, the Consumer Price Index. Many government obligations, such as Social Security payments and inflation-protected securities, are linked to CPI. If CPI rises, payouts rise automatically. Since the 1980s, the methodology for calculating CPI has been revised, introducing substitution bias and hedonic adjustments. These changes lower the reported figure. If steak becomes expensive and consumers shift to hamburger, the CPI tracks the hamburger, implying the cost of living has not increased as sharply, even though the standard of living has declined. These revisions reduce indexed payouts and save billions, while the lived experience of rising costs diverges from the reported data. The third tool is fiscal dominance, embodied in quantitative easing. When foreign nations slow their purchases of U.S. debt, the Federal Reserve steps in as buyer of last resort, printing money to purchase bonds that private investors are unwilling to hold at prevailing yields. By absorbing supply, the Fed suppresses yields and keeps government borrowing costs manageable. But the creation of new dollars expands the monetary base. Asset prices respond. Stocks and real estate rise, and portfolios swell. A sense of prosperity spreads, even though the currency itself is being diluted. The debt is serviced, but the currency is thinned. Once the Fed adopts the role of buyer of last resort, it becomes responsible for preventing the market from discovering that suppression is necessary. If the Fed tries to step back, yields would rise precisely when the Treasury is least able to tolerate them. The effect of this system is not evenly distributed. New money enters through the financial sector first. Major institutions deploy it into assets before prices fully adjust, while wage earners face higher rent and groceries only after asset values have already moved. This sequence amplifies inequality. The top 10% benefit from rising asset prices, while the bottom 90% contend with eroding purchasing power. The national debt is reduced in real terms by compressing the purchasing power of those who receive the new money last. As this dynamic intensifies, traditional saving strategies lose viability. Holding cash guarantees erosion. Holding long-term government bonds locks in negative real returns. Households are pushed toward risk assets simply to avoid loss. Stocks, real estate, and cryptocurrencies become defensive positions rather than speculative ones. The safe harbor of saving becomes a slow leak. Speculation becomes a defensive act. The economy shifts from accumulation to preservation, and the boundary between investor and gambler begins to blur. Yet the toolkit is not complete, because as long as physical cash exists, the system cannot fully enforce negative real rates. Physical cash offers an escape from punitive policy. A central bank digital currency removes that exit. If the dollar becomes fully digital, interest rates can be adjusted directly on balances. Negative rates imposed without the option of hoarding paper currency. In a cashless system, the state can influence not only the price of money, but its velocity and destination. Once the exit is removed, the population cannot opt out by stepping outside the system. The conclusion that follows is neither sudden nor theatrical. The United States is defaulting in real terms, not through refusal, but through dilution. The $38 trillion will not be repaid in the purchasing power in which it was borrowed. Those who hold scarce assets, such as real estate, gold, Bitcoin, and profitable businesses, stand to preserve value. Those who rely on currency and fixed claims absorb the erosion. The strategy is bureaucratic rather than dramatic, but it functions as default nonetheless. Once the system accepts default through dilution, it cannot claim a clean endpoint where the debt is paid. Because the method does not end with a final payment, it ends only if the erosion stops. Stopping would immediately expose the full nominal burden that is accumulated during the decline. History records moments when subtle measures give way to overt ones. In 1933, under Executive Order 6102, the United States criminalized private gold ownership and compelled citizens to surrender it. That precedent demonstrates that when fiscal pressure intensifies beyond what inflation and regulation can manage, legal authority expands. To understand how $38 trillion can disappear without a headline, one need only observe that the erasure occurs not by eliminating the debt number, but by diminishing the value of the unit in which it is measured.